previous episode of Money Shorts, we spoke about short-term investing. Today, we are going to talk about long-term investing. In a long-term investment, it means you have a lot of time before you need the money. And the moment you have a lot of time, it means you can take a bit more risk. Because as we've explained in the previous episodes, the higher the risk, the higher the return if you invest in good growth instruments. The higher risk you take means that it will be a bit rocky, like a roller coaster ride in the short term, but over the long term, because you have a long investment period or term, it will smooth out. And the reward for this is that you will get a higher return in the end of your investment term. The best way to invest for a long-term investment is to buy equity or shares. They are high-risk growth instruments. Shares are good for saving for retirement, saving for someday or things you will only need in 7 years or more, or saving for something specific for a period longer than 10 years before you need the money. Shares are not good for saving for immediate needs. It's also not good for saving for something you'll need in less than 1 year, because it might be a bad year in the market. Or saving for something specific for less than 5 years, because it might be a bad cycle in the market for the shares. Shares are high risk, high return growth instruments intended for long-term savings because it can beat inflation over time. Thank you for watching. Remember to subscribe so that you don't miss the next episode.